7.8% annual interest. That's what one bank in Vietnam is still dishing out, even as others slash their rates, affecting anyone looking to park their cash or finance a new venture. This isn't just a local news story, it's a real-time signal for global capital and passive income seekers watching emerging markets right now. According to data from the State Bank of Vietnam, the country's average interest rate has been steadily decreasing since 2021 from 6.5% to 5.25% currently, making the 7.8% rate offered by the Vietnamese bank a rare gem. The bank in question, Vietcombank, is one of the largest lenders in Vietnam, with over 300 branches nationwide and a significant presence in the country's growing fintech sector. Here's the bigger picture. On August 5, 2026, a sweep across 34 Vietnamese banks showed deposit rates holding steady overall. But dig a little deeper, and you see a fascinating split. Some players, like SeABank, are actively trimming their rates across several terms, indicating a shift in their strategy or market outlook. Meanwhile, others are doubling down, fighting to keep their top-tier offerings intact for depositors, creating distinct opportunities. For instance, Techcombank, Vietnam's largest private bank by assets, maintained its 7.2% per annum deposit rate for 12-month terms, while also introducing a new 7.5% rate for 24-month deposits, signaling confidence in its liquidity position. The data is sharp. SeABank, for example, dropped its 6-month rate from 4.95% to 4.65%, and their 12-month from 5.3% to 5.0% annually. They're now among the lowest for those terms. But on the flip side, ACB is still leading the pack with that impressive 7.8% for 12-month deposits, and LP Bank isn't far behind, holding strong at 7.3% for the same term. This isn't just noise. It's a clear divergence in strategy that savvy entrepreneurs track. A closer look at the interest rates reveals that TP Bank has also made a significant adjustment, reducing its 6-month rate by 0.15% to 4.8%, and its 12-month rate by 0.2% to 5.1% annually. Meanwhile, Vietcombank has opted to keep its rate steady, with its 6-month rate remaining at 4.75% and its 12-month rate at 5.25%. Here's what nobody mentions. While some banks are competing for the top spot, a solid 8 institutions currently offer 7% or more for 12-month deposits. This isn't just about high-yield savings. It signals an environment where capital can find attractive returns, potentially fueling local business expansion or providing a strong anchor for global passive income portfolios. For entrepreneurs, understanding your borrowing costs is crucial, but for savers, it's about choosing wisely for maximum return. Your actionable step today: research these specific banks, ACB, LP Bank, Saigon Bank, Bac A Bank, and compare their 12-month deposit rates. Even if you're not in Vietnam, understanding these market dynamics helps you spot similar opportunities in other emerging economies. If this kind of sharp financial insight helps you find your next opportunity, hit that subscribe button. Top analysts from firms like JPMorgan are watching this dynamic closely. They're predicting that while some aggressive rate cuts might continue, the market will likely see a floor forming soon. Why? Persistent inflation concerns, even with localized dips, mean central banks can only go so far before risking capital flight. Their consensus suggests smart money is already reallocating, moving out of short-term, low-yield instruments into longer-term bonds or real assets that offer better protection against currency fluctuations. What this means for you? Look at what the big players are doing. They're not chasing the highest advertised rate. They're strategizing for stability and growth, often into overlooked market segments. That's where the real profit lies. Globally, this mixed interest rate environment in emerging markets is causing a ripple. We're seeing capital flows shift. For instance, according to recent Bloomberg data, certain Asian bond markets are experiencing increased foreign investor interest, precisely because some regional banks are still offering competitive deposit rates compared to the near-zero yields in developed economies. This isn't just about big institutional money. It's about individual investors seeking higher returns. Think about it. If you're a freelancer building a nest egg, a 7.3% or even 7.8% annual return on deposit account, even if it's abroad, looks incredibly appealing when your local bank offers 0.5%. This arbitrage opportunity is driving a quiet but significant movement of funds. Looking back, the closest parallel to this split interest rate landscape was arguably the post-Asian financial crisis era in the late 90s, where some nations rapidly stabilized, while others grappled with currency devaluations and high borrowing costs. What happened then? Businesses that hedged against currency risk and diversified their funding sources thrived. Those overly reliant on single market financing or unhedged foreign debt faced significant challenges. Companies with robust export strategies and access to stable capital emerged stronger, often acquiring distressed assets at rock-bottom prices. Today, we're seeing a similar setup for those who understand how to leverage these disparate rates to their advantage, securing cheaper capital or higher returns. Unexpected winners in this environment are not just the big banks with high rates, but small to medium-sized export-oriented businesses. Why? They can potentially access cheaper credit from banks that are cutting rates, allowing them to expand production or upgrade tech. Meanwhile, their foreign currency earnings benefit from any local currency weakening, boosting their profit margins. Losers? Retirees and fixed-income earners who parked all their cash in the banks, now slashing rates. They're seeing their purchasing power erode. The real twist: the most agile entrepreneurs, the ones running Shopify stores selling to international markets or SaaS companies with global subscription models, they're the ones able to profit from both sides of this equation.